Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Today I'm going to talk about Enphase Energy, which is in the renewable energy space. These guys make solar micro-inverters. They've also recently added battery energy storage and EV charging stations to their portfolio, and they're primarily doing these things for residential customers. And if you're not familiar with what an inverter is and or what a micro-inverter is, inverters basically convert direct current, that's the power generated by solar panels, into grid compatible alternating current that you can use in your home or export into the grid. The difference between an inverter is a big box that is just connected to your solar panels, whereas a micro inverter lies under each individual solar panel. So there's benefits to either or, but essentially micro inverters allow you to kind of look at each individual panel on its own and creates less overall points of failure. Yes, each individual panel could fail, but the overall system won't fail if one microinverter fails versus if the overall inverter fails. So you'll still continue to generate power and you can do other things on an individual basis. And they also do a lot of software stuff that overall make the whole system work. If you have the entire package installed and you can kind of look at the data, et cetera, that way. So this the solar space obviously has had a lot of tailwinds propelling it forward. Low interest rates made the calculus between energy costs and solar generation a lot more favorable towards solar. There's a lot of government programs that say, well, if you install solar panels, there'll be a tax credit in there for you. The costs have come down. Energy efficiency of them has come up. The technology has gotten better. Maybe it's not quite as amazing as some would like it to be just yet, but it's certainly gotten better. And a lot of states have a lot of favorable programs that benefit solar as well. California's net metering is a good example. The amount of money you would get for actually selling back the energy to the grid was quite favorable for a long time. That's changed recently. So as we speak about stuff like that, net metering in California is an example of things that have gotten worse, that have the tailwinds have become headwinds a little bit. It might still make sense financially to sell energy back to the grid because you're still making money off of it if you have excess beyond what you can store in your battery and or use at home, but it's less than it used to be before. So it makes that calculation of energy cost versus solar a bit different. Same thing with rising interest rates, right? 2 to 3 years ago, you could have made that calculation because you were paying, hey, you were taking out a loan at 2 to 3%. Now suddenly that loan is 7 to 8%. That's a big difference. And the housing market, as it slows down, is going to impact their business as well. And that's why you saw this humongous growth up until Q2, Q1 really, Q2 maybe a little bit slowing growth, and then their future projections for Q3 is really what shocked the market and why this stock is down 50% in the last year, because they essentially said that, hey, in Q3, even though we've grown 40 to 50% in the last couple of quarters, and that's kind of what the market was expecting, based on where it was pricing it, we're actually going to shrink in Q3, and we'll look at that soon. So looking at their investor presentation here, we kind of talked about some of this stuff already. Again, this is a business that grew from 300 million in 2017 to 2.3 billion in revenue in 2022, expected to do a bit more in 2023. Really good cash flow generating business. They have a really solid balance sheet. We'll look at that soon. But essentially, this is a stock that has performed very well prior to this 1 year period. So as you look at the financials, yes, in the last year, they're down 55%, but 3 years out, you're still up 73%, a 20% annual return. 5 years out, you're up 2,600%, almost 100% annual return. So investors that have invested in the last year haven't done very well, but if you've been here for a long, long while, you've done pretty well. And the financials, yes, they're slowing, but we'll have to take a look as to whether or not it makes sense to invest in this stock for myself at today's values. As always, guys, I'm not a financial advisor, so please make sure to do your own due diligence as you look at the stock or any other stock. I just like to present my investing story and kind of see if I want to invest in this company. As always, if you like these videos, hit the like button. If you like what you're seeing here, subscribe, and I'll be making more of these videos through the year and onwards. So as I said, this is a pretty efficient company. Their margins are really solid. We're going to skip a lot of this stuff. You can certainly read it yourself. You see the Enphase Energy system. I talked about the micro-inverter, a lot of other systems. So now they've added this battery system. They've added this charger system. And this is a cool charger because it's a two-way charger. Essentially what can happen in a lot of these situations is you can take this charger. You can obviously charge your car with the energy that the solar panels are generating. But if you have battery left in your car and maybe your battery is out, you can actually take the battery that your car has, which is generally a much stronger battery than you might have in your home, and use that to power your home as well. So a lot of cars are starting to do that, and these guys are able to do that with their charger, which is a cool product. And it's growing. EVs are growing pretty quickly, so it's good that they have that and it adds something else to their arsenal. This is the bi-directional EV charger that I mentioned. It's vehicle to home and vehicle to grid charging as well as obviously grid to car. And then you've got home energy management with a lot of their own software. They've made some acquisitions in the last couple of years. They've generally been relatively small. The good thing about a company like this is that, hey, they generate a lot of free cash flow. You're talking in the neighborhood of 200 million a quarter in the last couple of quarters. And that allows them to do things without taking on a ton of debt. And those things have been relatively small tuck-in acquisitions or platform install of platforms or whatever, lead generation, etc. And then you've got platforms they talk about here. We'll finally get to the financials. And this is where the company has grown really quickly because they've added these additional products to their portfolio. In 2019, they were just making microinverters. So every time solar panels were installed in a home, they really could only make about $2,000 per install. Now going into 2022, they've added more premium microinverters with sunlight backup. They've added the battery system with additional software, etc. So they're taking in potentially about $12,000 per home if all of those things are installed. And that's certainly driven some of their growth in the last couple of years. And you can kind of see the growth has been huge, right? They went from 301 million bucks in quarterly revenue Q1 in 21, 441 in 22, and then 726 in 23, and that growth continued in Q2. Q3 is really where they start to run into some trouble, and you can kind of see the beginnings of potential trouble here as Q over Q growth has really slowed and actually turned negative. You went from 441 to 530 in the prior year, still big growth. And yeah, this number is obviously higher than Q2 of last year, but it's going down from Q1 of this year. And then as you look at Q3, their projections for Q3, what they've communicated to the market is, hey, we're going to be between 550 and 600. So that is actually a decrease in revenue from what they had in Q3 rather, 2022. So that is why the stock is down where it is. But despite that, this is still a company that is continuing to generate money, continuing to show decent revenue and free cash flow generation, and continuing to innovate, right? They're adding the battery, they're adding the EV charger. What else is up there? What else do they have up their sleeve? And kind of looking at their financials, looking at their Q2 earnings. I will obviously link these down below in the notes. Amazing growth here, amazing results for the last couple of years. Balance sheet is solid, but the problem that we run into is this, right? This is the revenue is actually falling, and that is mainly driven by falling shipments on the battery side of things. You can kind of see we're talking anywhere from 130 million battery shipments down to 122, down to 102, down to 82 in this quarter, and then they're projecting similar 80 to 100 megawatt hours of IQ batteries. That's lower than what you had in Q3 of 2022, much lower, which is why some of that growth is slowing. But it's also probably showing that maybe some of the micro-inverter shipments will also drop down. I don't know if they actually mentioned that anywhere here, but a fall in revenue like that is not terrible unless it continues for a long, long while. But it was a bit shocking to the market simply because it was unexpected, right? Maybe something slower, but to drop off about 111 million from the prior quarter when every quarter prior to that was growth and growth and growth, and that's 111 million on the top end. That is a bit of a concern. So again, looking at the financials of this company, we're going to do a quick financial overview. Balance sheet looks really good. You've got 1.8 billion in cash as of the latest quarter here. You've got about 1.2 billion in long-term debt. So there's some debt, but it's covered by cash. On the cash flow side, as we look at their prior estimates, right? This is a company that has grown really quickly again since 2018 and onwards. Some of that was driven by better technology, but a lot of that was driven by low interest rates and more people taking on debt to install solar panels. You kind of see where it started. It's sort of around the pandemic, past the pandemic. That's when the housing market sort of exploded. So these guys sort of move hand in hand with the housing market. More homes get purchased, more homes are there to install solar panels on, and they benefit from that trend. And they also benefited from the trend of very low interest rates, so they could borrow to install their solar panels when they bought their home at low interest rates. Now that interest rates are rising, less and less people are buying homes, less and less people are installing solar panels because the cost of both are increasing. And that could be a very big problem for these guys. If you believe the housing market's going to really take a slowdown, take a dip, people are going to be underwater, people aren't going to be buying their houses as much, this business will likely do the same, and it's already showing signs of that. You can kind of see the growth slowing down, and I think even this growth going into 23 and 24 is probably a bit optimistic. You're seeing, yeah, there's a bit of a slowdown, then it's starting to rise again, but as you look at the quarterly results and projections, I think some of this is a bit optimistic simply because, well, you've got that 8% reduction we just talked about in Q3. Then there's some continuing reductions into 24, and then suddenly it's growing, and then suddenly it's growing at a 42% clip. Seems unrealistic to me, so I'll probably make some more conservative assumptions in my financial modeling. Speaking of financial modeling, let us take a look at how that looks. I've kind of priced this out over here. You've got 135 million shares, about a market cap of 17.4 billion with negative debt, so an EV just shy of 17 billion at yesterday's closing of 128.11. So right now, basically based on 2022 actuals on a free cash flow basis, I like to look at things on a free cash flow basis. It's simple. It allows me to look at these companies on a comparative basis to other stocks I look at. This is getting a 4% free cash flow yield, which, given the fact that it's grown so much, is sort of reasonable. But with slowing growth, you might think that it might be a bit too pricey, given that you can get a risk-free rate in that 4.5+% range right now, depending on how long out you're looking at. And in the short term, it's more in the 5.5% range. So cash certainly isn't garbage anymore, and that makes some of these stocks less appealing on a long-term basis, especially if growth is starting to slow and maybe turning negative in the short term. And if that continues for a longer period of time, today's price point may not be that attractive. From a buyback perspective, they do have a $1 billion buyback that they issued with their last earnings. They did buy back some shares in the last couple of years. There's also some stock-based compensation in there that I'm including as full buyback negatives, but again, that's not going to be the case. But in general, they've been lowering their shares in the neighborhood of 180 to 100 million per year, and that might increase in the next couple of years. So as I look at the valuation I have here, I do have some sort of buyback baked into place. As we look at the assumptions, the estimates that are in here based on analyst estimates, I think these are pretty aggressive, with margins staying about where they are, pretty high, and then revenue starting to pick up in growth again until 2027. But with these assumptions, if the market allows this to keep the same free cash flow yield with a buyback of about 1.4 billion within that 5-year period, this is about an 18% annual return. I think that's probably optimistic. That's not really what I'm basing my investment case on, because I do not think a long-term free cash flow yield of 4% is reasonable. If growth is slowing, it's probably closer to 5 to 6%, which would make this a 9 to 13% return. Still pretty good, but not amazing, right? It's certainly a lot less than 18%. And that's especially true if interest rates stay elevated for a long time. And if they do, this would take a dual hit, because their business is really benefiting from low interest rates, from the purposes of solar installs and home purchases, etc. But also their valuation is benefiting from low interest rates as well. So maybe long term, if interest rates stay high, they take a double hit on a valuation perspective and on a slowing growth perspective. And one thing to keep in mind about this business, there's not a lot of reoccurring revenue here, right? This is, hey, somebody buys a home, they install solar panels and maybe a battery and maybe a charger, and that's kind of it, right? They're not going to do an installation every 5 years that they can kind of rehash. So they have to keep getting new and new and new and new installs forever and ever and ever. And market penetration in solar isn't really that high yet. So there's still a lot of runway there. But just keep that in mind until they release some sort of product that allow them to generate recurring revenue. This is very much a one-time revenue type deal on each individual solar install on a home. So if housing purchases slow down, if solar installs slow down, they will really take a hit. And if interest rates stay elevated for an extended period of time, that could be an extended period of low to no growth to negative growth for a company like this. So as I look at that, and that's kind of a more realistic picture, is that there's going to be some slowdown, and that slowdown is probably going to be a bit more extended and potentially put some pressure on margins for these guys. And I'm still giving them 14% revenue growth for 23, since that's mostly baked, and Q1 and Q2 had huge growth. So even if you have negative growth in Q3 and Q4, still going to have some overall growth. But then I'm really slowing it down in 24, maybe expecting a bit of an uptick in 25, 26, 27, if and when interest rates start to dip a bit. As always, this is going to be a benefit. This is going to be a business, rather, that is going to be hugely impacted by a recession. So if a recession happens, throw this out the window. This is going to be a business that's going to be cut in half if a recession happens, for sure. I mean, a lot of businesses will, but this one for sure will be cut in half because these are expensive things. Solar installs are expensive. People have to take out loans. This is anywhere from $30,000 to $50,000 or more, depending on the type of roof you're installing, the type of battery system you're installing, etc. I priced out the solar roof from Tesla not too long ago, and it was something like $150,000 for me with some batteries. It was ridiculous. So not really affordable for a lot of people. They do have to take out loans, and if interest rates are high, that is going to be a problem. So with that in mind, and a 30% buyback totaling about 1.3 billion in buybacks across that period, you're still talking about a company that generates 4+ billion in free cash flow across this 5-year period. Price today, if the free cash flow yield stays the same, it's about a 10% return. But I don't think that's true with slowing growth, right? This is a company that's been priced at 1 to 2% free cash flow yields because their growth was so humongous, right? Now the market's revaluing it. Now it's at 4%, which is certainly a lot more attractive. But if growth is slowing, and maybe if growth gets negative, this is going to be a problem for them. But with this type of slowing growth, I would probably want something more in that 5 to 7% range, which at this rate is anywhere from 0 to 6% of a return. And that's not ideal for me, right? That's not something I would look at and say, yes, I must buy it, because I want closer to 10%. And if I want 10%, if we're talking about 10% returns at a 6% yield, that's about a $90 price point that I would be interested in. If we're talking about 5%, you could probably get closer to $100, maybe $105. Yeah, $105. So depending on how you look at this, what free cash flow yield you'd be interested in based on these assumptions. Obviously, these assumptions are subject to change. This is more of a base case for me, not a bull case, not a bear case, kind of a base case, what I think might happen, but your assumptions might be slightly different. I'd probably want something closer to 6% here to be interested in this stock. So that'd be a $90 price point for me. So about 30% off where it is today. And you might say, that's crazy talk. This is a stock that's growing like crazy. You're never going to get it at $90. Again, it very much depends on what happens with their next earnings announcement. If they continue showing revenue degradation, if they continue showing that, hey, these interest rates are high and they're staying high, this is going to impact their business because solar installs are falling. People are not buying batteries as much, and batteries give us more revenue, potentially more margins. We are going to be in tough times for a while now. This could fall even further. I think this is a stock that if it goes to 60 in a year or two, I wouldn't be surprised, or even in a shorter time frame. Because if you look at this from a more bear perspective, right? If you kind of say, well, we're not going to see any growth from the next couple of years because of high interest rates, and then growth is going to be slowed when interest rates start dropping a little bit. We're still buying back some stock, but it's less because we're generating less free cash flow. It's about $1 billion in the next couple of years. Again, they have $1 billion stock purchase program in place now, but there's going to be some offsets with issuances of stock and/or stock-based compensation. To get back to that, maybe in this case it's 5 to 7. to get back to a 7% free cash flow yield or a 6% free cash flow yield at a 10% annual return, you got to be at $60, right? And I don't think that's like super bearish, right? If I want to be super bearish, I would be negative growth, because again, interest rates are going to impact this business a lot, and they've already shown that. They've already communicated that. They've already said, listen, in the next quarter, we're going to be down 10% almost, right? Potentially 10%, potentially more, depending on where we end up in our range. Generally, businesses tend to undercut some of those assumptions. Maybe they'll be closer to 600 plus, so maybe that won't be as bad. It'll really depend on their earnings. But what happens? What's going to drive the stock price after that is, what are they going to say for Q4? Are they going to actually shrink again? Are they going to shrink again in Q1 of 24? When are they going to get back to growth? The assumption here is that by Q2 2024 they are growing again. And if interest rates stay elevated, if they go up even further from where they are today, maybe that doesn't happen. Maybe they stay at low or no growth for a lot longer, and this kind of assumes that. And if that's the case, then if you want better long-term returns than the market from today's prices, you're not going to get that until the price point is at $60. Now, obviously, this is all sort of assumptions, but it's fun to do. And it's interesting to do and kind of look at this in a variety of ways. For me, I think once it gets to $90, I think I'll start getting interested. I think this is an area of the economy that certainly has a lot of growth potential. I mean, obviously the stock has done well for a reason. People are interested in renewable energy. People are interested in self-sufficiency on the energy side. They don't want to be dependent on the grid, which seems less and less reliable these days with all of the weather patterns that seem to be changing here and there. And the sun's probably always going to be there until the heat death of the universe. So we'll probably be okay with solar energy and being energy independent and having batteries at your home that allow you to store energy when and if the grid goes down, and allow you to generate energy when and if the sun is up. And being able to just be self-sufficient would be awesome. And I certainly want to install solar panels in my home eventually. I just have a ton of trees around here, so that is a bit of a bummer. But maybe once they become more efficient, maybe once the ability to generate energy from solar panels is better than it is today, and the trees aren't as much of an issue. And we also have a lot of, I'm in the Northeast, so winters are pretty dark. Fall is also somewhat dark. Summer is great, obviously, but I don't know if my home is the best for solar panels, but I can see myself installing these a couple of years from now. It's just that, hey, maybe not today, simply for those reasons and the fact that it's kind of expensive with rates where they are today. And maybe this is the new norm, right? Maybe rates will be like this forever. I mean, this is kind of where they were for a long, long time prior to 2008. It's just a more recent phenomenon. Low interest rates are a more recent phenomenon, and stocks may have to reprice to that phenomenon. If rates are 5 to 6% forever, and that is the new risk-free rate for a long, long time because of inflation, then 4% free cash flow yields are just not going to cut it for businesses where growth is slowing. You might need 5 to 6% even today with slowing growth. And if that's the case, that's a $90 price point, and that's kind of where I'd be interested in. So cool company, interesting company. I would certainly want to see more before I invest, and or a lower price before I invest. So Q3 earnings are going to be huge here. What do they actually get versus what they projected, and where do they go from here in terms of Q4? Technology here is really good. Like I said, one of the better companies in this space. If you want to invest in the residential solar space, I think you could do a lot worse than Enphase. If you are a buyer at 128.11, certainly you can have the idea that growth is actually going to be solid from today. And if growth is actually at where it's projected, if it gets back to 20% in 24 and 28% in 25, then today's price point is not that bad. Today's price point is not that bad, right? You're still potentially getting an 18% return if the market deems the yield that it's getting today the same yield that it gets in 2027. So that's pretty good. And I don't think that's ridiculous if growth is as estimated here. I just think that that's going to be tough to achieve based on what they showed in Q3 and based on where interest rates are. So for me, it's not an investment I want to get into right now, but it's one that I will put a price target of maybe $90, $95 in in my account. And then once that's hit, if I get a text that says Enphase is at $95, I will say, wow, that's great. Let me look at it again because maybe Q3 earnings were actually terrible and that's not a good deal at that point. Maybe I'll revisit it then. But until then, that's it for me, guys. Let me know what you think about Enphase. Let me know what you guys thought about this video. If you agree or disagree with anything. If you like the video, hit the like button. If you did like the video or like any of the other videos on my channel, hit the subscribe button. And as always, guys, I'm not a qualified financial advisor. Please do your own due diligence before making any financial investments. And remember, time in the market beats timing the market. This is a long-term play. When I do buy stocks, I don't expect them to grow or explode in the next year or two. They could certainly dive even further than the price point. I look at it as a buy. It's just, what is it going to be in 5 years? What is it going to be in 10 years? That's what I'm trying to get at. And hopefully that helps you in your investment analysis. So thanks for watching. Have a great rest of your day.